Well, today we're going to do a preview of the telecommunications sector ahead of the February 19 results. So if we start with the bad news, unfortunately the bad news is this is likely to be the worst set of numbers printed across the telecommunications sector in Australia, debatably ever. It's certainly going to be a messy set of results. That's the bad news. The good news, however, is that I think we've hit rock bottom, and obviously from there things can only improve. Stock market is supposedly a forward-looking indicator, so we are convinced that the bottom is in here. And after 4 years of significant underperformance by the sector, things are starting to look very interesting. So overall, we do have a neutral view on the telecommunications sector, but we are looking to get more positive over the next 6 months as we clear a couple of major catalysts for this sector, all of which are really around the competitive intensity of the industry. So if we talk on those three catalysts first, and then we'll get into the company specifics. The three catalysts we're looking for, the first is the launch of 5G. We've seen some very small launches now, but it's going to grow over this year and over time, more and more products launched in the 5G landscape. This is really significant because it moves competition from price-based competition onto quality of service. So that's a resetting of the competitive intensity in the mobile space. Similarly, there is an ACCC view, approval or not, of the TPG and Vodafone proposed merger, and that's due in April of this month. And then finally, by June of this year, we'll see 75% of households, so 3 out of 4 homes, will be on the NBN. So clearly, we've passed the hump there, over the mark there. The other interesting point to note is that the Labor government has also planted the seed that they may very well write down the NBN if they get elected later on this year. So they're the 3 or 4 main catalysts we're looking for there. I'll now touch base on a couple of the more noteworthy stocks and suggested funding sources. So for traders, generally speaking, we're not in a rush in the telco sector ahead of any results. We just want to let the dust settle and get through some of these results. But that said, the 2 more interesting ones coming up this Thursday, the 14th, are Telstra and Over the Wire, both reporting then. And our third stock of interest is Superloop, which is reporting on Monday, the 25th of February. So if we touch on Telstra, we are expecting EBITDA and the dividend both to decline around 20% year on year. We do expect guidance to be reiterated, but just want to highlight that it's definitely going to be a second half story, mainly because you'll have some provisioning and restructuring costs in the first half, and also 60% of CapEx will fall in the first half. So Telstra really will be a second half story. We are forecasting, as I said, the dividend to get cut by about 20%. We're looking for a dividend of 8.5 cents, which consists of a 3.5 cent special dividend and a 5 cent ordinary. There are some positives here for Telstra. We do expect an update on competition, and while we do think it's competitive, we think that's starting to lighten, and we certainly think the 5G roadmap they will talk to will be part of that. We do expect Telstra to continue to hold around 50% market share, so they should post some strong net adds both in the NBN and on the mobile side of things. And of course, we are expecting an update on the cost out story. In August, they told us they were a third of the way through the NBN pain and the cost out story. Clearly, we expect that to progress. And then finally, we do expect Telstra to spend some more time at this result talking about the new business segments, InfraCo or infrastructure business, and the retail sort of arm of the business. Now, this is important. It may only be optically, but when you start to split these two out, infrastructure style businesses do tend to trade on higher multiples. So you could potentially see the market add 70 cents to their valuation if they put the InfraCo business on an infrastructure style multiple. So admittedly, it is optics and financial engineering, but it is a very good start to resetting the base for Telstra. Next up, we have Over the Wire. We're looking for around 25% earnings per share and dividend growth at this result. Like Telstra, we do think Over the Wire will have a strong second half. That's partly because it's got very strong organic growth, but also because you get an extra 4 months of 2 acquisitions that it completed in November. And with Over the Wire, we are expecting a very clean set of results. So finally, Superloop. Superloop reports on Monday, the 25th of February. We are not buyers ahead of this stock ahead of the result, as we do flag there is some significant downside risk to earnings. There is a new accounting standard coming through, and also there's some big changes within the business, so we need to see where everything sits there. That said, on a constant accounting basis, we do expect EBITDA and NPAT to decline year on year. I think the key thing with Superloop, however, is that it is trading at a 20% discount to book value. This suggests to me we're at maximum pessimism in this stock. If you look at some other stocks, you look at Vocus, for example, it's trading or has traded about a 20% discount to book value as a turnaround story. It did trade at near 40% discount to book value when it was nearly breaching its debt covenants and people thought there was an emergency equity raising, and there was also a big write-down of intangibles coming. None of those things, in our opinion, are an issue for Superloop, so we don't think it will get that low. We do think the 20% discount is maximum pessimism here. We do think we need to get through this rebasing event, however, but just want to highlight that Superloop definitely has the best risk-reward profile out of all the stocks we cover. So this is a name we'll be looking to have a serious crack at come the February result once the dust settles and we know where we stand. In terms of funding sources, our least preferred stock is Speedcast. We're not comfortable with the gearing profile of this business or the earnings trajectory. This company continues to miss on the earnings front as their competitive market deteriorates and deteriorates. So it's not a stock that we feel people need to be in. So wrapping it up, we are comfortable accumulating over the wire ahead of the result. Same for Telstra with medium-term investors, but bearing in mind that we are expecting the dividend to be cut. And Superloop, we're looking to buy after the result once we know where we stand, and our preferred funding source is Speedcast. Thank you.